Brad Williams, Frugal Finance, a real-world example of index arbitrage. What is index arbitrage, you ask? Well, let me tell you. The futures price tied to the cost to carry model is known as the fair value futures price. In the following section, we'll look at an example detailing how to calculate the fair value of a December 2023 stock index future contract traded on November 30, 2023. So you want to know what that index number looks like. The December 2023 S&P stock index future closed at 1140. Okay, this number is not realistic, but just go with it. Closed at 1140 on November 30th. It probably was at 4140, but that's all right. The cash index price this date was 1139.45. The value of the compounded dividend stream expected to be paid out between November 30 and December 21st, the expiration date of the December contract, totaled 0.9 index points. Financing cost prevailing at the time for large credit-worthy borrowers was approximately 1.9% annualized over a 365-day year, or 0.010943% over the 21 days between November 30, 2023 and December 21, 2023 expiration date for the futures contract. With this detailed information, we can use the cost to carry model to compute the fair value for future prices. 1139.45 times 1 plus 0.001093 minus 0.9 equals 1139.80 index points. This is the projected fair value for the December 2023 futures contract at the close of trading on November 30, 2023. Given that the way in which the S&P futures contract is designed, each index point is worth $250. This means that the expected invoice price of the contract is $284,950. That is $250 per index point times 1139.80 index points. Since the closing future price on this day is 1140, it would appear that an arbitrage opportunity does not exist. The basis error for this contract, that is the actual futures price minus the fair value futures price, is only 0.20 index points. The annualized rate of return from a cash and carry arbitrage strategy at these prices would only be 0.3054%, less than the financing cost of 1.9%. The annualized rate of return for this strategy is determined by calculating the rate of return over the 21-day arbitrage period and then annualizing the 21-day rate of return over a 365-day year. 1140 divided by 1139 times 365 divided by 21 minus 1. Suppose that the December 2023 futures price on November 30, 2023 had been 1143 instead of the actual 1140. In this case, the rate of return on the strategy would be 4.99% annualized over a 365-day year. 1143 divided by 1139.80, 365, 21, 1. 1143. That's the only change. This rate of return is well above the annualized financing cost of 1.9%. In this case, the future price is above its fair market value as determined by the cost to carry model by 3.2 index points. Taking advantage of this rare arbitrage opportunity, the trader would simultaneously sell the overvalued futures and buy the undervalued cash index. In other words, the trader would buy low and sell high using a cash and carry arbitrage strategy. The cash flows for this cash and carry strategy are summarized in this table. On November 30, borrow $284,865 per contract, $1139.45 times 250 for 21 days at 1.9%. Buy stocks buy stocks in the S&P 500 for 284.86. You buy the index. You sell 1 December S&P 500 index future contract for 1143. December 21st, receive accumulated proceeds from invested dividends of 225.1 index points times 250. Sell stock for 285, 1140 index times 250. Total proceeds are 285, 225. Repaid debt of 285, 173.90. At expiration, the future price is set equal to the spot index value of 1140, giving a profit of 3 index units. In dollar terms, this is 3 index points times 250 index. That slight movement from 1143 from 1139 or 1140 will generate a $1,061 profit. That's per contract. That would be something, huh? Well, suppose instead that the December 23 futures price on November 30 had been 1138. In this case, the rate of return from this strategy would be 2.78% annualized over a 365-day year. This rate of return is above the trader's annualized financing cost of 1.9%. In this case, the future price is below its fair market value as determined by the cost to carry model by 1.9 index point. To take advantage of the rare arbitrage trade, the trader would simultaneously buy the undervalued cash futures and sell the overvalued cash index. The stocks would either be sold short or sold out of inventory. In other words, the trader would buy low and sell high using a reverse cash and carry arbitrage strategy. The cash flows for this cash and carry strategy are summarized below. You sell stock in the S&P for 284, you sell it. Before, what we were doing, we borrowed. Now you're shorting. You're going to lend that 284 for 21 days at 1.9%. You buy 1 December index future contract for 1138. 21st, receive proceeds from investments of the 285, 173. What is that? It's 284 times 21 days times 1.9%. Buy stock in the S&P 500 index for 285, and then at expiration, the future price is set equal to the index value of 1140, giving a profit of 2 index points or 250 per index. So you have a gain of 173 and a 500 profit or 673. Identifying an apparent arbitrage opportunity does not depend on the prices that prevail at expiration on December 21st, which happens to be 1140 index points. Instead, the arbitrage opportunity arises solely from a discrepancy between the current futures price and its fair value. The gain from the arbitrage position is locked in no matter what happens to stock prices between November 30 and December 21st. The success of the arbitrage depends upon identifying the misalignment between the actual futures price and the fair value futures price. However, at a given moment, the fair value future price depends upon the current price of 500 different stocks. So you can see how we, in a market that we live in today, can't move fast enough. There's too many obstacles. So now computers will take care of this. And this is pretty straightforward. So can you imagine you being fresh out of an MBA program, and your job is to look at possible arbitrage in every conceivable manner? And I'm sure there's a Bible out there at different banks. I just say Bible because there's probably endless number of possible arbitrage opportunities built into software programs that you're going to have to identify, and then you're going to start eliminating. So this is not for the casual. This would be like a tax accountant for the last 25 years, ingrained his entire or her life understanding the U.S. tax system. They find a possible tax advantage, and they're not going to share it with you, but they're going to identify it, and they're going to work with their top clients, and they're going to bill at huge premiums because they have a distinctive advantage, and you might be that future financial genius that either programs this writes an algorithm or does both, we'll come up with this great arbitrage opportunity. Brad Williams, Frugal Finance. That's what this is all about. Opportunities, baby. They're everywhere. It's just, can you find them?